Welcome to The Explainer. Today, we're diving into a massive economic mystery, one that revolves around what might just be the global economy's absolute biggest blind spot. We're talking about a threat that's hiding right in plain sight, a number so large it's almost incomprehensible, and yet the smartest people in the room might be missing the real story completely. To understand how a global crisis can sneak up on us, we actually have to travel back to a moment when the world was already on fire.
Picture this. The date is November 5th, 2008. It's less than 2 months after the catastrophic collapse of Lehman Brothers. The late Queen Elizabeth II was visiting the London School of Economics to open a new building. Now, she was surrounded by some of the most prominent economists in the entire world, experts who were desperately trying to explain the roaring global financial crisis. And as they enthusiastically detailed all the complex mechanisms of the crash, the Queen just paused. She looked at them and asked a perfectly simple, completely devastating question: why did no one see this coming? The experts were stunned. They literally had no immediate answer for her.
Well, it actually took months for the experts to craft a satisfactory response. Finally, in June 2009, the British Academy held a forum and sent a letter to Her Majesty. Their chilling answer? It wasn't a lack of intelligence or shortage of data. They described it as a failure of the collective imagination. You see, brilliant people, bankers, regulators, rating agencies, they missed the crisis because they were entirely siloed. It was like a giant puzzle where everyone was only looking at their own isolated piece, just assuming that if their small corner was fine, the whole system was safe. Almost no one was looking at the entire interconnected financial system as a single, vulnerable body. And this historical failure of imagination, it perfectly frames the intense paranoia we're seeing today about the next global crisis. Ever since the psychological trauma of 2008, analysts have been desperately searching the horizon for the next shock. There is a near-universal consensus that a new global crisis is looming, and more importantly, that the primary spark for this explosion will once again originate in the United States. But why? What's the trigger this time?
Section 1. A failure of imagination. Are we ignoring the next 2008?
Section 2. Unpacking U.S. national debt. The $39 trillion prime suspect.
Just a few weeks ago, Federal Reserve Chairman Jerome Powell visited Harvard University to speak to a room of 400 students. When asked what could push the U.S. financial system into a new crisis, his answer surprised a lot of people. He didn't point to the AI bubble. He didn't point to geopolitical conflicts. Instead, he gave a very blunt, entirely impartial warning about the unsustainable, explosive growth of American government debt. He clearly stated that the debt is growing much faster than the economy, warning that the endgame will not be good if nothing is done. And here is the number he's talking about: $39 trillion. It's an astronomical figure. But hey, like any good detective, we can't just look at the staggering raw data and panic, right? We need to look closer at what this total actually means and who is truly holding the bag.
So let's break this massive number down. The total is split into two main categories. First, we have about $7.7 trillion in intra-governmental holdings. Think of this as the government just moving money from its right pocket to its left pocket. Agencies borrowing from other government funds. It's all settled internally. But the real danger, the explosive part of the pie, is the $31.22 trillion classified as debt held by the public. This is the money owed to foreign governments, international investors, banks, and everyday individuals. These are external creditors who expect to be paid back.
Now here is the absolutely crucial point. On March 31st, 2026, the public debt officially matched 100% of the nominal gross domestic product of the United States. In simpler terms, the amount of money the U.S. government owes to the public became exactly equal to the entire economic output of the nation over the previous 12 months. This 100% threshold is a major psychological and economic milestone, and for sure, it triggered a wave of reactions across the financial world.
Section 3. The Japanese debt illusion. The ultimate alibi.
Whenever the U.S. hits that 100% threshold, a very common defense immediately pops up. People point to Japan. They say, hey, Japan's government debt to GDP ratio is over 200%, and they've survived for decades without a financial collapse. Therefore, America's 100% must be perfectly safe. At first glance, it sounds totally logical. But actually, scratch that. This comparison is a massive illusion. To understand why, we have to look at this fascinating 2025 research paper titled Japan's Debt Puzzle. The researchers point out that looking solely at Japan's raw gross debt is completely misleading. To solve the puzzle of why Japan hasn't collapsed, you have to look at their complete public sector balance sheet. You can't just look at the liabilities, the debts. You absolutely must look at the incredibly massive assets the Japanese government holds.
Let's look at how this builds, because the Japanese government does something totally unique. Normally, governments borrow to cover deficits or pay off debt, right? But the Japanese public sector borrows money specifically to invest it. They utilize a strategy known as the carry trade. Step 1. They take advantage of Japan's historically rock-bottom interest rates to borrow yen incredibly cheaply. Step 2. They take that borrowed money and buy high-yield foreign assets, like US dollars or foreign bonds, that pay a much higher interest rate. Step 3. They easily pay back the cheap yen and pocket the difference as profit. They're essentially acting exactly like a giant, highly profitable hedge fund. And this brilliantly illustrates the sheer scale of what they're doing. The Japanese public sector is literally the largest carry trade investor on the planet. To put this in perspective for you, in a single year, the entire global private sector executed about $250 billion in yen-funded carry trades. The Japanese government? They managed a staggering $2.5 trillion in foreign investments. They are operating on a scale 10 times larger than the rest of the world's private investors combined. So here is the final twist of the Japanese illusion. Yes, Japan's gross debt is massive, around 270% of their GDP. But look at their assets. Their financial assets, stocks, bonds, foreign investments total a whopping 192% of GDP. When you subtract those assets from the debts, Japan's actual net liability, their true debt burden, is only about 78%. It is completely manageable. So using Japan as an alibi to justify the American debt situation, it's entirely invalid.
Section 4. The point of no return, when debt stops working. Okay, since we can't use Japan as a comforting shield anymore, we have to look the American situation dead in the eye. The nature and trajectory of American borrowing is a completely different, much darker story. The U.S. is not borrowing cheaply to build a massive, profitable wealth fund. The core issue isn't just the size of the debt, but the speed at which it's growing relative to the economy. Just think about this concerning gap. Since the year 2000, U.S. government debt has grown at an average annual rate of about 8%. During that exact same period, the U.S. nominal GDP, the actual economy itself, has only grown at an average of 4.6%. The debt is growing almost twice as fast as the economy. By any economic standard, this is the very definition of an unsustainable trajectory.
And that brings us to a critical, kind of grim economic concept: the diminishing marginal returns of debt. In the past, when the government borrowed $1, it might generate $1 or more in economic growth. But today, each newly borrowed dollar is adding only mere pennies to the actual economy. Why? Because the majority of this borrowed money isn't going into income-generating investments or vital infrastructure. It's funding non-productive consumption to cover budget deficits, things like military hardware that is consumed or destroyed in conflicts, which leaves behind no capital assets to generate future revenue to pay off the debt. Because money isn't generating returns, the government just has to borrow more and more just to keep the lights on. Let's walk through these staggering figures. The budget deficit for fiscal year 2025 was $1.7 trillion. For 2026, it's expected to hit $2 trillion. But the most shocking fact is this. In just the first 3 months of the current fiscal year, the U.S. government spent $270 billion solely on interest payments. Think about that. That is more money than the United States spent on national defense during that exact same period. Which leads us to a really sobering milestone: $1 trillion. For the fiscal year 2026, the net interest payments, just the cost of servicing the debt, are expected to exceed $1 trillion. That is nearly triple what the government paid in net interest just a few years ago in 2020. They are trapped in a vicious cycle where they must constantly borrow more money just to pay the interest on the money they already borrowed. Section 5. Waiting for the shock. The next American collapse. All right, this brings us to the climax of our explainer. The renowned Harvard economist Kenneth Rogoff recently published a severe and sobering warning in the journal Foreign Affairs. He argues that the idea of a U.S. debt crisis, something that honestly hasn't happened in a century, is no longer an unthinkable scenario. Rogoff methodically lists the 4 classic conditions that historically precede a sovereign debt and financial crisis. 1. Fragile state finances. 2. High long-term interest rates.
3, a paralyzed political system incapable of reining in borrowing. And 4, a sudden, unexpected shock. Grimly, as Rogoff points out, the United States currently and actively meets the first 3 conditions perfectly.
Which brings this whole narrative full circle. We're right back to that failure of imagination. Just like in the lead up to 2008, the kindling is stacked, the system is highly fragile, and the conditions are absolutely primed. All the experts are looking at their own little pieces of the board, but the overall system is critically vulnerable. All that's missing is the trigger, a sudden, unexpected shock that no one sees coming. We are quite literally just waiting for the shock.
If that shock hits and this threat remains uncontained, Rogoff outlines some catastrophic potential fallout scenarios. We could be looking at severe, punishing austerity measures. We could see a return to the crippling high inflation of the 1970s. We might witness intense financial repression, or even the unthinkable, a partial default. Regardless of the exact mix, a crisis of this magnitude would fundamentally threaten global economic stability and deeply undermine the US dollar's status as the world's primary reserve currency. So we're left staring at maybe the most vital question of our time. If or when this new financial crisis detonates within the United States, will America be able to weather the storm and emerge with its superpower status intact? Or are we currently witnessing, buried deep in these terrifying debt ledgers, the inevitable beginning of imperial decline? I want you to really let the gravity of that question sink in. Thank you for joining me on this explainer. Keep your eyes open and never stop questioning the consensus.